Hey, Mr. Finance, please explain to me what margins are. Margins are one of my favorite topics and are often discussed in the business world. We spend a lot of time discussing margins. You will hear terms like sales margins, profit margins, operating margins, etc. We will talk about sales margins. This is the difference between the selling price and the cost of goods for selling. Margins can tell you a lot about how a business operates, and because of this are often closely guarded secrets. Let's take a look at how they're calculated. To understand how to calculate margins, you need to know your net sales and have access to the cost of goods for your products. If you have not done so, take a look at my short video about calculating net sales, but just to remind you, it is gross sales minus sales discounts equals your net sales. And remember, value-added tax is not included in your sales calculations. Cost of goods is the cost of manufacturing or purchasing the goods or products sold. Your accounting department can help you here. If they're reluctant to provide you with the information, ask for a mixed calculation, assuming you are selling multiple products or perhaps some type of reference price. Cost of goods is also called cost of sales and is abbreviated COGS or COS, varies by business, but the concept is the same. Let's take a brief look at cost of goods sold. In a manufacturing environment, there is usually a set cost price for each item manufactured, or in some cases, the manufacturing division will often sell the products to a sales division by means of a transfer price. This is your cost of goods sold. In most other cases, if the seller is not part of the company that manufactures the goods or products are purchased directly or through wholesalers, brokers, etc., and the cost of purchase is the cost of goods sold. As you see, this is the famous middleman. In a service type of business such as a restaurant, the ingredients used to make the meals are your cost of goods, as well as any purchased items for reselling, such as beverages. The cost of goods sold for a meal will be different for the cost of goods for a beverage, but you can calculate a mixed cost of goods for an average meal. And now the complex math. Net sales minus cost of goods equals your margin. And here's the important part. Calculate your margin as a percentage of net sales. In other words, divide your margin by the net sales. It is a percentage value that you use to compare and discuss margins. One more important thing, this is not your profit. For multiple products, it would look like this example. To simplify, we assume that the sale price is the net sale price, in other words, after discounts. On the left column, we see the line descriptions. Across the top, we see the product names, Vial 1, Vial 2, and Vial 3, as well as a total column. In the center, we see the individual sales units, cost per unit, and unit sell price, as well as total product sales, cost of goods, and margins. On the bottom, we see the margins as a percentage of sales. When we talk about performance of individual products, we can see that it is easier to talk about a margin percentage for each product to understand their impact, but we cannot ignore the absolute values. Finally, we see the combined margin of 56.5% for all these products. This could represent a product line, a sales rep, a region, etc. This gives us additional understanding of what is going on in the business. Are the margins good? This depends on the business, as it tends to vary across industries. We celebrated at a former employer for gaining a major contract with 12% margins. Another former employer was told by the headquarters office that our local margins of 60% were too high until we explained the cost structure for operating in Germany. Another employer, 60% would have been a strategic necessity to keep higher margin products moving, meaning it was too low. Bottom line is, it was critical for us to understand the margins and why they are the way they are. When you hear people discuss margins, they are generally referring to the percentages. When you discuss absolute values, it is usually to put something in perspective. In other words, we generated 1 million margin with Vial 1, 4 million euros margin with vial 2 and 1.2 million margin with vial 3, etc. The same applies when people discuss a high or low margin business, which can be products, branches, teams, regions, locations, etc. Percentages make them comparable with absolute values, adding to the discussion. Margins put things in perspective. It is clear that when you say the margin is 60%, that for each dollar or euro sales, 60 cents is left over to pay for the business operations and profit. Margins can be calculated for actual sales, budget sales, investment proposals, etc. Speaking of investment proposals, I remember one company that shot down any investment proposal where the margins were less than 95%. Margins are also generally positive. If you have negative margins, there better be a strategic region that supports it, or you will not last very long in your job or in the marketplace. A negative margin means you are paying someone to buy your product and using up your cash. More on this in another video. Margins told us where to look to understand our business. We calculated margins on products, people, teams, customers, etc., and made many changes of this as a result. We, of course, helped our sales teams to understand their margins, and in some cases, they could negotiate better sales bonuses for improving their customer margins. As you can see now, margins can involve a lot of detail in spite of the simplicity in calculating them, and it is important to understand how to use them. We will be adding more videos on how to evaluate the use of margins and encourage you to stay tuned for more on business finance. And as always, thank you for watching.